So, the big news since yesterday has been that the US Treasury 30-year yield crossed 5.3%, the highest since 2007, or let's say the great financial crisis. Now, I watched an interesting interview this morning on Bloomberg by Fidelity, and the gentleman made two great points. So, he said, what were yields like before the great financial crisis? And then again, what were yields like in a previous capex cycle? So these are important questions to ask, and we should talk about it a little bit. So, first of all, since the great financial crisis, we've had a long era of low rates. So, there is some normalization here, right? So, rates were slashed when things got bad, but rates pushing higher and higher also signals some trouble. So, even if that's not a lot, but it does signal some trouble. And we know what that trouble is, right? US debt levels have been rising and they continue to rise. So, as debt levels become higher and higher, investors want more return on their money for taking on more risk. And the second issue, of course, is the war in the Middle East. We don't see any signs of ending. In fact, we're not seeing any signs that the US wants to rush any of this. We heard that yesterday as well. But let's consider the capex cycle argument a little bit more here, because I think that's a very interesting one. So, for the last 2 decades, we have been led by capex light companies. Capex is capital investment or capital expenditure. And what we've been seeing is tech companies and software companies taking the lead. Think about Google and think about, Meta. So, the era of spending is quite new to many investors, right? And this spending is going into data centers and very heavy equipment. And we have to admit that the nature of investing has also changed quite a bit. So we have more retail participation now, and they're sitting on a pile of wealth that has also largely been generated by the stock market. So it's something that they know, right? Bonds is not something they know. So our threshold for taking risk has definitely moved up. And not to mention, this capex sits behind a story that is very lucrative. So the issue is very simple. If you could buy AI stocks that could continue to go up and up and up, why would you buy boring treasury bonds? And better yet, these companies are now issuing bonds themselves. So if we were willing to take on ownership through stocks, we'd probably be willing to take on the debt of these companies as well. So higher rates don't always spell trouble. Yes, it will weigh on the market a little bit to a certain extent. What we want to watch is whether the 10-year crosses the 5% mark. But overall, there is an explanation to all of this, and it may not be a bad one.